a broadening bull market.
The classic 90s rock song, Wake Me Up When September Ends, didn't resonate this past month as the market balked at the seasonal market jitters that almost every strategist was predicting, with both Canada and the US climbing to hit all-time highs during the month. This marks the fourth straight month in a row of all-time new highs. And so that's not just momentum, that's a really confident market. In Canada, it's not just the Blue Jays hitting home runs, but the materials sector continues to benefit from the rally in gold stocks. And of course, that's benefiting HGGG. And of course, we saw a supply disruption in copper that had some of the other materials stocks also participating this month. We'd say that the number of sectors, though, that are participating in this rally is continuing to increase, and that's healthy. We see strong participation in our HLIF and our low vol strategies in Canada as well. In the US, the tech sectors continue their leadership, but the story is broadening, and we see that across the sectors and think that that's very healthy for the markets. Still, though, some investors are starting to question, can the growth last? Stock valuations are elevated, and that's really turning the conversation to both the macro, the technical outlook, and valuations.
Macro, technicals, and sentiment.
Okay, so we've made some changes modestly to our internal dashboard on risk. First, government policy and central bank decisions, the risk there remain very high. Good news, though, is that inflation is continuing to trend in the right direction and investor confidence is up. Job growth, though, balancing that out, is slowing slightly, and that might be actually a sign that the economy is just cooling enough. But stock valuations are elevated on the back of higher profit forecasts that continue to rise. Before we get into the valuation debate, we need to really look and see what's been driving the markets. Looking just at two measures, a cap-weighted market, that gives more weighting to the giants like Apple and Nvidia, and an equally weighted market that treats all the companies with the same weightings. When the market cap weighted index is nearly double that of the equally weighted one, it tells us that there have been a handful of the mega cap companies driving a lot of the returns. Of course, from a technical analysis standpoint, we do see some mixed indicators, but we can also see that the magnitude of the spread over the 200-day average and the duration of it, this really isn't an unprecedented time from a technical standpoint. And that's even more so for the equally weighted index. So this brings us to the big question everyone is asking. Are stocks too expensive for the growth to continue? So on the back of that, let's dive into the valuation debate.
Barbelling the valuation debate.
Okay, look, at first glance, the overall market valuations are elevated, measured by the price-to-earnings ratio. However, there is a reason for that. Profit forecasts are rising in the US. This means that companies are expected to earn more, which can justify a higher price. So on growth, just think about this. The top 5 hyperscalers in the US have a research and development budget this year that's larger than the 2,000 companies in Europe's R&D budgets. Look, it's going to take time to see the benefits of all those capital expenditures and spending, but we see that as a positive as we look out over the medium term. From an equal weight perspective, gives us a different perspective. Outside of the largest tech giants, the average stock is actually not overly expensive. You can also see this in kind of a barbell type of market where some sectors are expensive, but there's still some other areas that have some great value. And this is really why diversification is so important, to capture some of these high growth areas, but also owning some of these undervalued and perhaps bargain areas within the market. They will eventually have the day, but the catalysts are often unknown, as are the timing. So having barbells in the portfolio makes sense. Some high growth balanced with some more consistent defensive areas and factors. And I think one great example of this is the recent spike in healthcare sector at the end of last month, with valuations extremely suppressed and compressed. A small piece of good news was enough to send some of those stocks jumping double digits. Way too early to call a change in the trend, but it can remind us that value can be quickly rewarded.
Portfolio updates and new insights.
In fund news this month, we've launched HHIS.U, which is a US dollar denominated version of our popular HHIS, a great strategy for those that want a Canadian product but want to invest in US dollars. We also announced that we launched 4 additional single stock ETFs in the US, and they'll also be added over the course of the month to the HHIS portfolio. We have a separate high income shares monthly piece for those that are interested that breaks down a number of key metrics. And also we give a little bit of portfolio discussions and some dynamics that are impacting HHIS. Keep an eye out for upcoming insights on healthcare, the yield curve, and the anatomy of option pricing, what drives distribution levels and option premiums. And lastly, we'll be giving an update on the drivers of the Bitcoin ecosystem. Until then, go Blue Jays.
Subscribe to Harvest ETFs Insights. Join us and stay informed.